Hey performance management students, Steve Willis here. In this video, I'm going to help you pass your upcoming performance management exam. I'm going to take you through the topic of flexible budgeting. We'll do past exam question Corfe together. That's from Practice Exam 1, which you can find in the ACCA Practice platform. Guys, if you like these videos, you can get a whole bunch more at my website, ACCAexamhelp.com. So check it out. The link is above. All right, guys, let's get started. Guys, I've got the question open on my screen here. Before we start, please pause the video. Try this on your own, either in the practice platform, Practice Exam 1, in the Section B questions, or from the PDF that you can find in the description of the video. Okay, pause the video, try it on your own. Welcome back. Let's do this question together. Remember your exam approach. You're going to do the Section B questions last in the exam, okay? And you're going to spend 17 minutes per scenario, right? That's 10 marks multiplied by 1.7 minutes. And you're going to start with the easiest questions, which are usually the theoretical questions. So let's hit next, next, next. Let's check out all 5 screens and do the easiest ones first. Okay, and I'm going to go to the end. That is the easiest one, okay, for me. And this is a question about spreadsheets. The management accountant intends to use a spreadsheet for the flexible budget in order to analyze performance of the new batteries. So we're analyzing performance with the spreadsheet. Which statements are true? Which ones are false? I like to go through them and eliminate the obviously incorrect answers. And remember, we're actually looking for the best solution, the best answer here, maybe not the perfect answer, okay? So we're looking for the best answer. Now, I'm going to eliminate statement 3. As you guys know, spreadsheets work with numerical data or quantitative data. So spreadsheets can take account of qualitative factors to allow decisions to be fully evaluated, right? That one is false. How about statement 1? The user can change input variables and a new version of the budget can be quickly produced. Yes, that is a benefit of spreadsheets, that you can change figures in cells to quickly produce a new version of a budget. So we like statement 1. Statement 2, errors in a formula can be easily traced and data is difficult to corrupt or can be difficult to corrupt in a spreadsheet. That's statement 2. I don't like that one. Guys, it's difficult to find errors, and as you know, it's easy to corrupt data in a spreadsheet. You can easily make a transposition error when you're entering a figure into a cell or you're setting an exchange rate, and that can be difficult to track down. So I'm not liking statement 2. How about the last one? Managers can carry out sensitivity analysis more easily. Well, more easily than what? If it's held in a spreadsheet, well, more easily than on paper, we can assume, right? So yes, spreadsheets will help us do basic math more easily than working on paper. I'm liking statement 4. Okay, so the answer, guys, would be the third option. Moving to question 24, another theoretical question, checking if statements are true. And now we're talking about features of a flexible budgeting approach. Okay, now let's go through it. The budget could be time consuming to produce. This is statement 1, because splitting out the semi-variable costs might not be straightforward. That one is a reasonable answer. Okay, if you remember, the semi-variable costs have a fixed component and a variable component, and that could be difficult in a battery company, in a battery manufacturing company, because production will be complex. Let's check the next statement and see if it's reasonable. The range of output over which assumptions about how costs will behave, and they're talking there about how a fixed cost might turn into a stepped cost at a certain activity level, and then the behavior of the semi-variable costs. What is the fixed part? What is the variable part? And the range of output could be difficult to determine. Yeah, that's reasonable. That's going to take some investigation into our operations to work out all of that information. So I'm going to say 2 is true. At least it's reasonable. 3, the flexible budget will give managers more opportunity to include budgetary slack. Remember, that's managers putting in a little bit of buffer, and that is false. That one goes with annual incremental budgeting. If a manager thinks that the IT costs will be $200,000, maybe they put in a little bit of extra just to give them a little buffer. Guys, that's not a problem of flexible budgeting. The budget will encourage all activities and their value to the organization to be reviewed and assessed. Nope, that one goes with activity-based budgeting. So the answer, team, is 1 and 2 are correct. Moving on. We're following the approach of easy marks. First, we're doing the easier questions in the set. These tend to be the theoretical questions, but not always. We're going to try question 23 now. This is a difficult question. It's confusing. Okay, so if you were stuck on this one, you are not alone. Virtually everybody that I meet who tries this question gets stuck on it. Okay, and it goes back to the basics of variance analysis that were taught in the MA, in paper MA. Let me give you a very quick review of the theory that's being tested here. Okay, we're looking at the sales variances. There are 2 of them. There is a sales volume variance. There is a sales price variance. Okay. You remember the sales volume variance is related to the units. Okay. Why is the actual profit different from the budgeted profit? Due to the change in units produced and sold. Then the sales price variance tells us why is profit different from the budget due to a change in the selling price. So you got to remember that. Okay. Then you need to remember that the calculation for the sales volume variance, we're looking at the original budget versus the flexed budget, and that's looking at the impact of the change in units. Guys, if this is fuzzy for you, find my video on variance review on the sales price and the sales volume variance, and you can go back and revise this topic if it's fuzzy for you at this moment. Okay? Moving on, the price variance then, that's looking at the flexed sales versus the actual sales. Okay? So what this question is, the intention of the question writer was this. We have our original budget. Then we flex that budget to the actual activity. That's then the flexed budget. Then we compare the flexed budget to the actual results. So when we flex a budget, we move from original budget to flexed. The original budget drops off. Now when we're comparing the flexed to the actual, that's what's being tested here. Okay? So when the budget is flexed, I'm going to the fourth one. The sales variance will include the sales mix and the sales quantity variance and the sales price. Guys, this one goes out immediately. We only have a mix and a quantity variance when we're selling multiple products. And here we're only selling one new battery. Okay? So the fourth one goes out. I'm going to show you the correct one. When the budget is flexed, now we're going from flexed to actual, and the activity level is identical. So the only variance that's left is the sales price variance. So that's the third one here. Okay? That's the correct option. Okay? When the budget is flexed, the sales variance will include both sales volume and sales price. That one drops out. Okay? And when the budget is flexed, the sales variance will only include the volume. That one drops out because the volume variance is between the budget and the flexed. Guys, there you go. That's question 23, the trickiest of the questions, in my opinion, in question Corfe. Team, moving on. We're moving now to the numerical questions, the calculation questions, and that would be question number 1, where they ask us if our production is 80% of the maximum, what will the total production cost be? So the first step is to get the activity level at 80%. Can we do that? Sure we can. The maximum capacity, right, is 262,500. So if we multiply 0.8 times 262,500, that's the activity level that we're looking for, right? And that's 210,000, okay? So we need to do a budget for 210,000 units, okay? That's the first step, identifying the activity level. Now that we know we're going for 210,000, we've got to work out the variable costs, the fixed costs, and the stepped costs. The fixed costs will be easy. They tell us right here, okay? The fixed costs don't change. 750,000. So let's just plug that figure in. The fixed costs will be 750. Now, the variable cost will be the material and the labor. So the material cost per unit, that would be the 740 divided by the 185. That's going to come to $4 per unit. The labor cost, okay, that's going to come to 5.5 per unit. Okay, 550. So the variable cost per unit will then be 9.5. 4 plus 5.5, that equals 9.5 variable cost per unit multiplied by 210,000. Okay, and that comes to 1995. The last thing we need to do is the stepped costs. We need to figure out how many supervisors we need to hire. And we need one supervisor for every 50,000 that we produce. So if we're going to produce 210,000, that's 50, that's 100, that's 150, that's 200, right? So we need 4 supervisors to 200,000. And we need to hire a 5th supervisor as soon as we go over 200,000, right? Because it takes 1 for 50,000. So that's 5 supervisors. 5 supervisors multiplied by 35,000. That comes to 175,000. We add all of this up. and we get 2920 and 3 zeros, right? So the answer, guys, is the last option right there. I like question 21 better than the previous one. I found that one easier, actually. Okay, it took more time, but it was easier to understand, at least for me. Okay, friends, last but not least, let's do question 22 together. 22 is testing your knowledge of the high-low approach. If you know the high-low approach, we've got to get the variable cost first, then the fixed cost. Okay, once we get that, we can calculate a total cost. High-low method, and I've taken the question to a bigger piece of scratch paper so we can do this. The way I do it is this. I'm going to make a little template. And we can do change in the costs divided by the change in the units. That's going to be equal to my estimated variable cost per unit. We come here, we've got to find the high cost, which is right here, 850,000. The low cost, 450,000. Then we have the high hours, 5,000, and the low, 1.8 thousand. If we do it in thousands, just to save some keystrokes in our calculator, that's going to be the high minus the low divided by the high minus the low. Okay, and that variable cost is then coming to 125 per hour. Okay, that's the first piece of the puzzle, the variable cost per hour. Now that we have the variable cost, the next step is to get the fixed cost. And if you remember the total cost equation, my total cost is equal to my fixed cost plus my variable cost multiplied by the activity level. And we know that my total cost at the higher level is what? 850,000 is equal to my fixed costs plus 125 multiplied by the higher activity level, okay, which is 5,000. Okay, we can use some basic algebra there, and we can then calculate our fixed costs. Okay, and my fixed costs will then come to $225,000. And we are trying to understand what is the total cost when we produce 210,000 units. So we need one more piece of information here. Check this out. Every 1,000 units takes 14 hours to produce. If we have 210,000, that's going to be, the total cost will then be 210,000 units, okay, divided by 1,000, right? That tells us the number of batches, right? For every 1,000 that we produce, it takes 14 hours, okay? So that gives me the total hours, and that comes to 2940 hours. Once we have that information, we can now use that total cost equation again, and we can say the total cost when we produce those units and use 2940 hours, that will be equal to the fixed costs, 225,000 plus 2940 multiplied by the $125 per hour from above. And that comes to 592, 500, rounding up to the nearest thousand is 593,000. 593,000. So the answer is the second option, 593. Guys, there you go. That's question 22, the last of question Corfe. Performance management team, I hope you found this video helpful. Again, if you want more of these videos, head over to www.acccaexamhelp.com. Good luck on your upcoming exam.